Hello and welcome to our virtual coffee talk, the opportunities and pitfalls of doing business in Latin America. Before our webinar begins today, I would like to go over a few housekeeping items. In case you do not know, you can earn 1 CPE credit by attending our presentation today. To receive the credit, you must stay connected to the webcast for the entire presentation and participate by responding to at least 3 of our interactive questions. You will receive an email within 5 to 7 business days with instructions on how to access your CPE certificate. We also invite you to complete the course evaluation that will occur at the end of the webinar. We appreciate any feedback that you give us. I will now pass it over to Kevin Jacobs. Over to you, Kevin.
Great, thank you. And thanks everyone for joining us. It's going to be an interesting panel to discuss a lot of different aspects. And when preparing for this panel, we'll talk about the agenda in just a minute. There was a lot of interesting nuances that people should be aware of. And so it was really exciting to me that my colleague, Alfonso, who's a managing director at A&M, as well as my old friend, Devin Bodo, who's a partner at Weil Gotshal, are joining us. And as always, Kevin DeYoung is joining us from Wolters Kluwer and will show us Answer Connect and how you can use it to learn more about some of the topics we're talking about. I am going a little bit faster than normal because we have a lot to cover and it's really interesting. So with that, Devin, why don't you tell us what they're planning on hearing about today?
Yeah, great. Thanks, Kevin, and thank you, Wolters Kluwer, as well as Alvarez and Marcel for inviting me. It's great to be with my old friend Kevin Jacobs, as well as my dear old friend and colleague Alfonso Paetti. We have a really action-packed agenda today. We're going to cover a bit about how to navigate the somewhat difficult interaction of U.S. tax rules and, more importantly, local country tax rules in Latin America about acquisitions and how we structure them, how we push down debt, how we make it all work in an efficient manner and don't get off sides with any of those various complicating rules. There we'll pivot to talking about doing how we do business in Latin America, talk a little bit about foreign tax credits and the like, touch for a moment on PFIC. Also super important, and I actually think as important it is going into Latin America, knowing how to operate there, knowing how to do an acquisition there, is how to exit and how to do it efficiently, how to capture gains and not have them eaten up. And Alfonso is actually going to take us into a deep dive into how that works and what really is the value drivers. Alfonso, do you want to talk a little bit about some of the really specific LATAM pieces on this agenda just to drive it home?
Sure. So we really want to, well, first of all, because I want to say I'm very pleased to be speaking with both of you, Kevin and Devin. It's been a great challenge to prepare for this presentation with you guys. And going back to Devin's point, what we try to cover is to really navigate all the reasons why you need to really plan your investment in Latin America. From the different reasons why you invest, could be private equity, could be venture capital, could be integrating to your operating group, and really all the nuances you need to take into considerations during the different stage, from pre-acquisition, acquisition, and post-acquisition integration. We'll cover all that, and we also cover what's very interesting, which is how the most commonly used structures in the past are now evolving from the holding jurisdictions, etc. So we have a packed agenda. We're very looking forward to discuss this with you.
Yeah, look, why don't we turn to the polling question, which again, we'll have a few polling questions for CPE purposes. Does your company currently operate in Latin America? Pretty easy answers: yes, no, but my company is currently thinking of doing so. Just flat no or not applicable. So if you could answer the poll question, that would be great.
And while they're doing that, Alfonso, if you want to start discussing some of the acquisition and structuring considerations.
Sure. Thank you, Kevin. As I was mentioning earlier, there may be different reasons why you're investing in Latin America, from acquiring an operating entity to integrate in your group, to just private equity investment, to venture capital. And the structures you put in place may be different. And it could be the consideration of that cash flow and dividend flow to the exit strategy, which we'll cover towards the end of this presentation. What I want to discuss today is some of the most commonly used structures to invest in Latin America. As you all probably know, Latin America is a very diverse region, and depending where your targets are, you may consider one investment or the other. What we see is a tendency of some of the jurisdictions who historically didn't impose withholding tax on dividends, such as Brazil in the tax reform that's coming. We'll discuss very briefly later. Colombia increased the dividends. How most of the countries in Latin America are now adding withholding tax on dividends at pretty high rates. So investing through a treaty jurisdictions become more and more relevant to you. And what we want to discuss here is the most commonly used jurisdictions. Everybody's aware of the Dutch entities to invest. They were very commonly used to invest in Brazil. Spain with the ETVE regime, which has also been changing in the past few years. But now there's a new upcoming player, and it's the UK. The reason is very simple. The UK has been signing double tax treaties in the past with some very relevant jurisdictions in Latin America. And we see the UK as now being some of those players to be considered when you do the analysis. The other consideration is really the substance requirements and how this has been changing and how this has been challenged by the tax authorities more and more in Latin America jurisdictions, where in the past you just basically had the most common structure with the board of directors. Now there is some more considerations, and groups, even in private equity, are looking at this from a more, I was going to say, holistic perspective, saying, in what of those countries could I have the relevant substance or activity to really cover the treaty protection? So that's one of the things that we see more and more. The other thing is obviously the changes in local legislations. The Netherlands now has withholding tax out. The common structures used don't work as well anymore if you don't have a treaty jurisdiction on top of your holding company in the Netherlands. Spain has been changing the ETV regime in the past few years. It was first imposing some anticipated taxation in the partial payments for corporate taxes that were later refunded. That was imposed, I think it was like close to 10 years ago, to now limiting the 100% participation exemption to only 95%. So therefore now Spain as a holding company now would tax you at a 1.25% your dividends flowing through Spain. So all those considerations have made the structuring to invest in Latin America evolving in the past few years. The other component, yep, go ahead, Devin.
Just chime in there for a second, because when I'm sitting in a boardroom and I'm talking about how to invest in, it really comes down to a few things that you've hit on. So let's just draw those out. One, stability of the regime that you're investing from, and that goes to your substance point. So, hey, what substance is required in the UK? And that'll dovetail with another point in a moment. But what do I really have to do to get treaty qualification? And sometimes it's even, we have wealthy individuals, right, trying to qualify under special regimes. Italy has a great new one for high net worth individuals, or Switzerland, which do those give you access to their treaty networks, not dissimilar to the UK? And then what's the stability in the investee jurisdiction, right? In terms of Latin American stability and how will they tax? We know in Brazil, we've got a ton of discussions about tax reform that can fundamentally alter the way that investments are done. Overlaying on top of that entire thing is the stability of global tax regimes. And that's one thing that I think you and I have been surprised at times. We've also seen quite a bit of people make mistakes in that, in many cases, Latin America, whether they're in the OECD or not, will early adopt OECD principles. And I'm thinking Mexico, for example, who early adopts a lot. And what does early adoption mean? Sometimes you're overly aggressive to what the global community is doing with respect to being a recipient of capital. And all of that needs to go into that calculus on how you set up for the long term, or even in a private equity context, from an investment cycle term, how we invest into the region. So I think all of that, is very relevant. And the one thing that always gives me pause, I think the UK is a great jurisdiction, but they're new to the scene and you have to take it. That being said, we know Spain, particularly with respect to Brazil and certain hybrid payments for cross-border flows of cash quite a few years ago now, completely changed the treatment in Spain, right? So maybe not as stable. So you have this kind of Rubik's Cube of comparison that you have to go through. And I think they're all great points you've made, Alfonso.
And Devin, I was going to say, you cover a lot of ground in that comment, which is from both angles, right? The holding jurisdiction perspective and the changes in law, you mentioned Spain, but we also need to consider MLI, which has now, for example, made the Netherlands almost equal than Spain to invest in Mexico, which in the past was different. So there's a lot to consider there. And also you mentioned the OECD countries, right? And political instability, and for the first, probably not for the first time, but really you will see here in a tax presentation another consideration, which is bilateral investment treaties and how, multinationals are now a little bit, I was going to say, uneasy with the political instability in some of the countries. We all know the recent election, the recent one from Petro in Colombia. And now people looking at the bilateral investment treaties, which gives you that additional asset protection if you invest through certain countries. So it's certainly now you combine the global scene, MLI, local legislation level, the holding company, substance requirement, and VAT. It's really a combination of the three, to your point, that you need to put into consideration how to invest.
Yeah, and on the back end of this presentation, we're going to get a little bit of Wolters Kluwer's tool on treaties. So I think that's going to be a real important piece to pay attention to as we move through the presentation.
Right, and the other thing just to note, and I think Devin, you hinted at it, the early adoption of OECD is really interesting when you're starting to look at, okay, well, we have the pillars, where are the pillars moving? How is this going to impact investments as far as which countries are going to possibly be early adopters? What is their early adoption going to look like? So there's a lot of things and moving pieces here. And so I think in part what the takeaway is, there's not a one size fits all. And the other part of it is it's not a stagnant answer. It's something that, as Alfonso noted, with the elections and everything, you're constantly having to reevaluate. It's no longer the position where, oh, we did this during the last deal, so let's just do it again. We need to constantly be evaluating, is this the right structure for us and going forward, as well as the existing structure.
Yeah, look, Kevin, I mean, in Brazil, we have an election coming up here. A possible change of power to a government that had already been in place, which ended up for a period being a hot time for foreign investment there. But do their politics change, and what does that mean for tax policy? The Receita Federal, how are they going to operate? So it is always interesting throughout the region because of that movement. Maybe we should talk a little bit about financing in Mexico, because I think that's certainly a hot topic, Alfonso. I get questions about all the time. Maybe you want to walk through that?
Sure, and this is where we were covering any debt push down into Latin America, which is extremely, like everywhere else in the world, it becomes more and more challenging from a tax perspective. But basically, just some of the structures are commonly used to invest in Mexico, as you can see here, which is basically creating your new vehicle before you acquire target in Mexico and leverage that entity prior to a merger. What we can say here is that the deductibility of that interest when you finance that would need to be sustained to be related to the business because it has been challenged by the tax authorities. So it's really becoming challenging. I would say we're highlighting here Mexico of some of those structures that if the business considerations align, you could still get some of that debt pushed down, either total or partially, but becoming more and more challenging. And again, not only in Latin America, but I think overall in general to get the debt pushed down that in the past we were all familiar with and was not as challenged as it is today.
And Alfonso, from a Mexico perspective, the wrap, globally on Mexico, besides, Kevin, the early adoption of OECD principles at times, or at least certain provisions. From a Mexican tax authority perspective, do you find it I have found it a pretty aggressive authority where they are going to take a pro-fisc standpoint, and so you really do have to have your ducks in a row when you're designing a structure for Mexico, particularly in financing or otherwise. You find the same in your practice, Alfonso?
Oh, absolutely. I mean, even taking a step back, and you were mentioning that, Devin, I think, Kevin, you alluded to that as well, is you see how the OECD members, which for people that are not familiar in Latin America, it's Mexico, Colombia, Costa Rica, and Chile. You see the early adopters of many of those measures. And Mexico, I was going to say, was so early that even before we had BEPS defined, they were already implementing some BEPS measures that are very aggressive. So to your point, Devin, completely see that on a day-to-day basis. But they have, I was going to say, not only those positioned by the tax authorities reviewing their structures, but really, if you look at legislation in Mexico, and now I would say even Colombia, within the upcoming tax reforms, you see very, very, I don't know if the word is aggressive, but very early followers of the BEPS initiatives in some of those measures.
Yeah, I mean, one thing that strikes me when I take a step back and look at the slide too, that's just, this is pure finance. This isn't particularly tax, it's driven by tax. But if you see the bank off to the left, everybody, the one thing to keep in mind with even Mexico and Brazil, which are the two largest economies in Latin America, the interest rates on that debt can be significantly higher than, particularly if you're up above from a strategic investor versus a private equity, but it applies to private equities too, right? That bank debt can certainly have a very high interest rate to it, vis-a-vis what you can do on a global system, just by nature of the banking systems in the region.
Yeah, and maybe Kevin, yeah, I was going to ask you to move to the next slide. If you see here now with the debt coming from your parent company in a European jurisdiction, which is, by the way, a real case we worked recently. It may be coming because, to your point, Devin, you get access to that financing at the level of either your FinCo in Europe or anything like that. And then this combination becomes the other one that you put into consideration. We put Spain and Netherlands here as potential. We'll see on the exit strategy why for Mexico those are the one that works the best. But again, this is a structure that's not uncommon. There's many business reasons why you may lend from the EU entity there other than tax. And again, worked on a recent case where that was exactly the case, and we're sustaining that for that potential challenge, Devin, from the Mexican tax authorities. But one of the few, I was going to say, structures that still could allow for that debt push down.
Yeah, which obviously can be a huge benefit to anyone. Oh wow, one of my favorite.
I was going to say,
I love this one.
I was waiting for your reaction. So Brazil, different. I was going to say you'll see that on our later, almost the final slides when we talk about the planning in general in the region. Brazil also different here, and the most common structure you see Devin's excitement. I'm sure he's implemented a few of these with the FIP in Brazil, basically to prepare for that exit strategy and mitigate the capital gain tax. As you can see on the right side of your slide, this would significantly reduce your capital gain tax. And if you have over less than 40% of that FIP, which is also not uncommon, you may actually reduce it, exempt that. And Devin, you want to share some practical?
Well, look, the only thing I will say is that as with all of Latin America, Brazil, near and dear to my heart, is no different. It requires an analysis. Look, FIPs are useful tools for private equity. They do require maintenance and administration that comes with a cost with it that has to be factored in. We still see them, them being used because of the particularly with a diversified investment group coming in, where you've got less than 40%, or you're able to diversify among funds or otherwise. So yeah, again, this one's just part of the toolbox, has to be analyzed and looked at very, whenever one is looking at Brazil.
Yeah, and two things before we move out of Brazil. The first one you will see there on our slides, which is, I have a hard time talking about Brazilian tax reform without sharing half a smile, because I always say, since I started doing tax, and it's been a while, they've been talking about a tax reform in Brazil. One of these days it will happen. Lula has expressed, I think it was last week, his intent to push the tax reform and specifically on indirect taxes, but on a corporate tax. And the fifth structure will be challenged if this tax reform passes. The second thing, and Devon alluded to it before, is when you invest in Brazil and you look at the cash flow out, as you know, right now, there's no withholding tax on dividends in Brazil. That may change if the tax reform passes. They're talking about introducing withholding tax on dividends. And the other thing is the hybrid instrument that Devon was mentioning earlier, which is the interest on equity. In Brazil, you can contribute your shareholder based on the capital you own. It's an interest rate that is fixed on a yearly basis. And in the past, those structures with the Netherlands and way back with Spain, as recipient of that interest and equity, will consider that as a dividend, therefore non-tax. Both concepts, the interest on equity and the FIT, are included in the potential tax reform, so therefore could be eliminated going forward.
And do keep in mind, and it's beyond the scope of this presentation, but if you're a U.S. multinational investing into Brazil, that interest on that equity was used quite extensively, even if the money needed to be reinvested. Look, Brazil's a growing economy, huge opportunity there. So people are in many businesses are disinclined to pull money out. So what they would do is pull money out, get interest on net equity, and just contribute it back down, giving them more ability to pull out money later. But again, just a circular cash for U.S. tax purposes that ended up being disregarded. In a mean-spirited legislative move, not just for that, but for many other reasons, we were tortured with Section 901M, which took that type of planning away. So you do have to keep in mind all the foreign tax credit rules, which brings us kind of to the next piece. This is with respect to Mexico. It could be with respect to really any of the countries in Latin America, which is how do the new foreign, and this is near and dear, Kevin, to your heart as well, how do we actually get foreign tax credits out of the region? A lot of taxes. So let's take a lot, particularly, Alfonso mentioned it, there's an alphabet soup of taxes that are indirect taxes in Brazil. We all know those aren't creditable for US, right? Before this tax reform, they weren't creditable. ICMS, IOF, city, all these crazy various taxes that I think they're going to try and reform, and I wish them great luck in their simplification of their indirect taxes. I'm not going to hold my breath on that. It's again, it's very complicated. A lot of people have a lot at stake, but they weren't creditable for the U.S. They are sunk costs. So when you're doing your model, right, which Kevin, you guys do a lot of, right? You're doing a model that's just pure cost to you, right? That's a pure cost for doing business there. Luckily, Brazil's a high growth economy that money can be made beyond that tax, but they still have a significant direct tax. It's two taxes interacting together. It ends up to be about 34% or so there. In Mexico, we have as well a direct tax regime, some indirect tax as well. But how do we make those creditable? Well, you can see here, again, we don't want to make this a foreign tax credit seminar, but we do have to understand, right? We've got a few requirements. We've got a realization requirement, a gross receipts requirement. That's where a lot of the Brazil stuff is failing, and a cost recovery requirement and an attribution requirement. We go here, and why we use Mexico? Why pick on Mexico? Because they have a double tax treaty with the U.S. And the double tax treaty, while it provides a mild apostolic blessing and cure for foreign tax credits, it is not a cure-all. And Kevin, I think you'd agree with that, right? It's not, it provides that the regulations provide that a foreign tax needs to be a income tax under the double tax treaty. While Mexico does have a treaty with us, it can't really be relied upon for purposes of subpart F and guilty. So we have to go back and fall back. Just Brazil has no treaty, and I'm going to go out on a limb. It's not going to ever have one with the U.S. I've been right about that and wrong about Hungary for the better part of 2 decades. So of Hungary going away. So it's although even that has changed, but on Hungary. But in any event. Look, when we go through, we went through a couple of points of Mexico of why we have differing rules between Mexico and the U.S. And remember, if anything, the foreign tax credit rules stand for the following proposition. Some people call it the Frank Sinatra, you do it my way. Or it's in Latin America, we joke, we call it Tio Sam or Chio Sam in Portuguese, which is Uncle Sam. And that means that we are having an extrajudicial application of our tax law. We're, in less fancy language, we're forcing everybody to become under the American regime. And we're going to talk about that with transfer pricing. And we're going to put a real point on it because it's a real problem in the region. But there's a few things that differ in Mexico. I don't know if you want to go through it, Alfonso, or I can, the annual inflationary adjustment.
Go ahead. Go ahead.
Okay.
Devin.
You've got an annual inflationary adjustment. It requires inclusions or deductions based upon adjustments in short-term accounts like payables and receivables based on inflation. It does seem to be inconsistent with the realization requirement, right? There's nothing that's happening other than inflation that adjusts the effects of payables and receivables. Look, it's a bit of a blessing, those of us who have practiced and lived here in the States. We don't have that problem. We think the inflation we're having now is crazy. In Latin America, they had to adjust the tax system to take into account inflation in order to keep, I guess, fundamental fairness of the regime in check. And whether it was increasing deductions because the deduction was accrued but not taken in an earlier year, where it'll become less valuable the longer it's outstanding. But again, it doesn't comport with the U.S. Goodwill is not deductible in Mexico. And notice there's not even a provision for tax basis in goodwill. That seems pretty inconsistent with the ability to recover costs. Under tax payment rule, which disallows deductions for certain costs like interest, rents, royalties, etc. Again, early adoption based on Action 2 and BEPS. It's really not consistent with our 267 Cap A. So it may, again, not be a creditable, it cause credit problems because it's not consistent with the cost recovery. Also thin cap, which are different than our, obviously we have thin cap rules, but they're nothing compared to what we have in the region. So let me pause there, Kevin. When you're looking at Mexico and some of these provisions, and we'll put up this, which is, before I let you answer, which provision in the Inflation Reduction Act of 2002 is most of interest to you? Excise tax on stock redemptions, corporate AMT, energy tax, or I don't really care about any of them, none of the above. And for the record, I've clients across the board that each of those are important. But going back to foreign tax credits, while folks answer the polling question, Kevin, how do you think about when you're looking at Mexico and the like and foreign tax credits? How's your thought process with being able to capture those? You think it's a strict comparison to the U.S. or do you think the regs provide a little bit of flexibility to allow us to capture foreign tax credits for some of this on the margins?
So I do think that the regulations have caused a lot of questions as to what extent you're able to claim a credit for some of these taxes. There's been an outcry from the public since the regs have been out, in which Treasury has announced, we're continuing to think about it and trying to evaluate it. I do think that there might be some wiggle room in some places on the fringes, as you suggested, to claim foreign tax credits in some of the jurisdictions. But, I think on the next few slides, we're going to be highlighting some of the requirements that are there. And it really becomes a hard question as to how comfortable can you get that we actually satisfy all of these requirements, and really how much do people actually know in order to make these comparisons? And there's these questions of, if you have the smallest of changes that's different, does that preclude it? And is that intended to preclude it? And people are saying, well, no, it's not, but the language suggests it may be. So Devin, I don't know if I can give you a warm fuzzy on the answer on this one, but
I can't help you either, Kevin, because at the end of the day, it's not so much that we're fighting with the IRS about this yet.
Yeah.
Right? It's trying to get our attest firms, when you do have a audit, not to put up a reserve against it. And the position that I've run into is a very conservative one. So I guess I'm with you. I think it's very challenging. I think and the firms are all over the place, right? The 4+2 of the audit firms are a bit in different places on different pieces of the foreign tax credit rules, and you have to know how to navigate that. I mean, I think that's the important thing is knowing that that's out there. I mean, I know Kevin, because Kevin and I are involved with a couple of professional organizations. We're in constant dialogue with the IRS, trying to clarify that guidance. I would say that it's like we'll get dribs and drabs, but there's not going to be a fundamental clarification on this, largely because this was such a big, voluminous regulatory package. It's very hard for them to otherwise go out and try and make calls on various pieces. Let's move to the 90 the deeper dive. So look, as we know, it has to be an income tax, and what that means, it needs to satisfy the net gain requirement or something tantamount, a surtax that is tantamount to an income tax. Before it was great, right? What's the predominant character of the tax? Is it an income tax? Now we have it is broadened the disallowance in that it is not only the foreign law, or it is only the foreign law, not how it applies in practice. So that is really something when you're drilling in. Is there realization? What is a gross receipts tax? What about cost recovery? Can I get recovery for the cost I've put into the asset? And of course, on attribution. In that, let's talk a bit about attribution. And what's really important there on the next slide is that there is no longer the jurisdictional nexus requirement, which is good because that's a lot of words, but we've transformed it into the attribution requirement. It's no longer a separate requirement. It is part of net gain, but it requires that there is a connection between the income in the taxing jurisdiction. And I do think that is a very important piece. And we're going to talk a bit about it. And on that lower left, arm's length principles. That sounds awfully American to me, right? It's no destination-based criteria. And that's going to be important in a second, and we'll talk about it on transfer pricing. On non-residents, how is the sourcing working? Where's the property located, right? Can I get a credit for a tax that looks like our FERPTA tax? Well, as everybody knows on the webcast, FERPTA was a bit of I guess it was a bit xenophobic maneuver, or it was a way, that's a cynic, or it was a way to capture money from foreign real estate investors in the US. that immediately got transported around the world, right? Mexico has one, we know Germany has one, right? There's a ton of that around, but they aren't exactly the same. And does it really drive by the status of the property, or how does that work? And you need to analyze each and every one of those taxes. And that, again, that's important in the region because there are a number of Latin American regimes that fall there. The really big elephant in the room is the next slide. And this one, it came as a shock to me. And I'm going to put it in context of something that kind of a rumor that came after. What this says is either you do it the American transfer pricing way, functions and risks, or you lose your tax credits. So take for Brazil, for example. It is largely a formulaic approach to transfer pricing, and therefore doesn't rely on functions and risks. It relies on activities and how the activities are executed. And so from that perspective, we are in a situation in which, not that you lose a pro rata piece of your Brazilian tax from a foreign tax rate, you lose all of it. And Kevin and I actually, we were at and Alfonso were at the ABA, IFA, IBA LATAM conference, and we cornered the chief counsel corporate, or chief counsel international, and said, look, here's a side suggestion from Latin America. Rather than killing Brazilian tax credits, why wouldn't you just recalculate it based upon US norms, right? And what would have been the tax creditable under US norms? They took that under advisement. I am not going to hold my breath, but it is in front of the government. They understand it. It would increase complexity, but when you have a jurisdiction like Brazil, that is a big number. So that was one to pay attention to. There are other areas throughout the region that have that. It's just most pronounced there. Now, why did I say it's a bit odd? Maybe folks on the webcast know, maybe they don't. I don't think I'm rolling out new news, but the government is looking at the check the box regime. This will be absolutely seismic in Latin America, seismic in the rest of the world too, for US investors, right? So at least the rumor, and again, it's rumor, so don't take this away, is that they'll effectively eliminate electivity in eligible entities in the check the box regime for non-US entities. That would be quite problematic for a lot of planning and how we think about the region. But it's also very different than the policy that's in the regulations for foreign tax credits, because what that rule would say is whatever the local country, so a limitada in Brazil, or is that treated as a flow through, or is that treated as a body corporate for purposes? And we'll just follow that for purposes of entity classification, thus ceding entity classification to the foreign taxing jurisdiction. You see the dichotomy. Foreign tax credits, do it my way, maybe, at least it's on the horizon, possibly a move towards following the foreign country's tax. So again, a little bit disjointed, but that's why both globally, but specifically in the region, we do have to pay attention. And this foreign tax credit, regulation package was so important.
Right,
and Devin, as a side note, maybe worth mentioning that we'll see what happens first, if we get some clarity around this, or Brazil adopts more OECD kind of transfer pricing rules, which is something that's under discussion as well right now.
Yeah, to me, that's both a legal matter, Alfonso, and I think you'll agree with me on this, but you have an entire industry built around their regime. There's a cultural issue of converting to functions and risks, and how supply chains are done and how they were designed before. I think it'd be a very big deal for them to move over there. Kevin, I know you want to chime in on something. Sorry about that.
Yeah, well, I was just going to say, the check the box regs is obviously, when I was in the service, something that has always been a great focus. you could go back to your
put in.
Yeah, just saying, I'll neither confirm nor deny any interest in it. But what I'll say is, there has been a lot of rumors, but with that said, I wouldn't necessarily hold my breath as of yet to say that it's going to come to fruition immediately. There has been a lot of speculation as far as, when the foreign tax credit rates dropped out, I actually had a representative from, a Brazilian conglomerate that pretty much said, oh, was this an anti-Brazil package? We're hearing rumors that this was designed to be solely focused on Brazil. And so, this is a big question that you're raising in the sense of the all or nothing approach causes a lot of heartache. Clearly, it would be resolved by addressing the pro rata. Hopefully, the government's listening to those comments and considering them. But in mindful of the time, Devin, what should they know about covered withholding taxes so we have time for exit strategies?
Well, yeah, this is quick hitter stuff right here. This is, I keep this on my desk. This is a great slide Kevin put together. Let's talk about 4 different covered withholding taxes. Hey, look, a general imposed net income tax. Same country imposes a general income tax. We know that's creditable, right? That's qualified. What about a non-resident gross basis tax? It must be a gross base tax based on non-residents. No duplication, no income tax is imposed on the same tax base. We know that, and so that's not, so we have no duplication. And of course, the source-based attribution withholding tax must be imposed on income from gross receipts that included in the base of the foreign tax on the basis of source. Really important. The last bullet's the most critical. Foreign sourcing rules have to be reasonably similar to the U.S. sourcing rules, so you need to dive into both countries' sourcing rules to get there. I know we have a polling question you wanted to ask, and then we can talk about leaving not only the webcast, but Latin America, exiting.
Yeah, so it's really easy. Would you like to be contacted by A&M or Weill Gotshal to further discuss doing business in Latin America? And so with that, Alfonso, while they're answering that, why don't you start discussing the efficient exiting strategies? We have about 8 minutes or so then Kevin can walk us through Answer Connect.
Sure. So on exit strategy, we briefly mentioned, and here the first comment I want to make is that the direct and indirect transfer tax on transfer of shares rules in Latin America have been evolving very actively in the past few years. So specifically the indirect transfer of shares may have strong implications from you when you restructure Latin America. But before that, and focusing on the exit strategies, there's basically 2. There are, as I said, top of mind because of the high capital gain taxes if you're gonna exit your investment in Mexico, for example. And we early mentioned that's why we had Spain and Netherlands, which are the only 2 double tax treaties that allow you for a reduced capital gain taxes in Mexico and reduce it substantially, 35 to 10%. And the second one, which is interesting, is the one with Chile, which not only allows you for reduced capital gain tax if you exit your investment in Chile, but also, and with U.S. treaty being, I was going to say, in the last stages to be approved, and Kevin, maybe you have some new insights of how close we are to getting that treaty, also impacts you on any dividends distribution. You're probably familiar in Chile, it's not per se withholding tax on dividends. It's actually a full taxation. They don't look at double tax treaties to reduce withholding tax. They basically consider a 35% taxation. But right now, with the domestic law as it is, if you're held in Chile by a non-tax jurisdiction, your taxation can be as high as 44.45%. So really focusing on this, because we have this slide, you would see for Mexico, the most commonly was the Netherlands. Why? It's just the clauses of the treaties were, I was going to say, friendlier than the Spanish treaty because they both incorporate the 10%. That is changing right now. The MLA is going to change that, and now you have equal opportunities. Now you need to consider where you're going to have more substance because you're going to be challenged from a Mexican perspective most likely of how you invest in Mexico. So on exit strategies, the treaties can help you mitigate in certain countries capital gain tax. But in interest of time.
Well, another thing to point out, Alfonso, I think it works if you're not flowing money out of a jurisdiction or they don't have a withholding tax on dividend flow, like take for a Brazil, a non-interest on net equity Brazil scenario. A lot of times what you'll see is an interposed jurisdiction that from a US perspective that may be transparent and the ability to exit kind of one tier above. And there is a lot of discussions on what substance you need there from a Latin American, will they pierce through that transparent for US yet not transparent for local Latin American country and impose a non-resident capital gain. In some jurisdictions, it does cause an issue in that you're unable to get a goodwill step up in Brazil, for example, which an agio step up there if you're selling up above, right? You've got to have a Brazil acquire Brazil, and then combine and do all the stuff they need to do there. So it does have some costs, but it does. We do see it for growth businesses, ones that are not going to repatriate money during the course of their ownership cycle and are going to, effectively grow the business and don't need the cash flow, therefore don't need the treaty access. So again, it's not, as we've said a couple of times, not one size fits all. But this last piece to me is if you want to be successful in Latin America, this is the slide for you, Alfonso.
That's absolutely right. And as you can see here, we just put some bullets. We'll need probably just a full session just to cover these in details. And interesting enough, as I mentioned at the beginning of our chat, is Brazil always completely different to some of the other jurisdictions. You see here supply chain LATAM excluding Brazil, and then supply chain Brazil. Devin mentioned earlier, in supply chain in general in Latin America, I think there's still opportunities, centralization of activities, moving some of your key assets around if you're actually buying and selling, and that could really make efficiencies. You have to understand that the tax rate in most of those countries is above 30%. So all the planning you can do, supply chain can be substantially impactful in your overall ETR. And then Brazil. Brazil, Devin mentioned earlier, Brazil is a completely different animal. Just the domestic supply chain with the different states that have different indirect tax and even different indirect tax rates can create inefficiencies, whether you import in one port or the other, you move and your clients are in one place or the other. I must mention here that has been a challenge for years. We have a very strong team in A&M in Brazil that has developed a technology tool that can actually give you access to where are your inefficiencies from an indirect tax perspective. That's how important that is. And then the IP planning, and Devin, all the years we've been working together, you've been hearing me talking about this, which is in Latin America, you still can move some of that IP, centralization of that, protect your assets. But then in Brazil, it's completely different. Because of those indirect taxes that we mentioned earlier, any royalty payment, anything you pay out of Brazil can be as high as 40%. And most of those are indirect taxes, therefore not creditable. So the planning in Brazil usually goes around how, and now the light went off, how you actually, is there a possibility for you to onshore some of that IP? It's a completely different approach that you have in Latin America. And then just to go through the list, and again, in interest of time, I don't think we could have a webcast on Latin America without mentioning the FX considerations. I was going to say that the easy one to consider right now is Argentina and all the struggles you have to make any payments out of Argentina. Most of the clients come to us saying, is there anything new? Is there anything creative? Can we get that cash out of Argentina? There has been some legislative changes in the past weeks. There's been some structures around. And then related but non-related, because you add a component, is the cash pooling, which is so commonly used in Europe because of that common legislation, not so common in Latin America. still possible depending on how you do it, but the FX restrictions and withholding taxes, you have to put that in place because it can have a strong impact. And last but not least, whenever you look at Latin America, and even though it goes a little bit beyond tax, is the labor considerations.
But Alfonso,
yep.
All of these from top to bottom, what it strikes me, and I've spent so much time with your partners in Brazil, Ponciano and others, is the due diligence in the region, whether it's identifying labor issues or bad IP planning or supply chain opportunities, both from an opportunity and a risk assessment perspective throughout the region, just absolutely critical. You have to have it both on buyer and vendor due diligence. It's just absolutely critical, much more so in this region than it is. It's important everywhere, but it's much more important here to get that done right and to get it done in a way that not only identifies the risks, but the opportunities. And that's the difference of success and not success in the region, is going through that process. If diligence is rushed or it's very very high level, it is a recipe for a challenging investment in the region.
Oh, you're absolutely right. And the team in Brazil, you mentioned, led by Ponciano, Emerson, and others, that due diligence process is a completely different approach. To your point, not only because you evaluate the risk like you do in any due diligence, but actually identifying those opportunities going forward. And labor, but indirect taxes as well. You know, the indirect tax due diligence in Brazil is just like another due diligence on top of just the regular due diligence in any other country. So to your point, Evan, absolutely critical, that due diligence process, not only to eliminate risk, but to identify opportunities going forward. And Kevin, I think, again, I was going to say I can talk about this slide all day, but I know we're running out of time.
Yeah, no, I wanted to take a moment to quickly thank Alfonso and Devin for their time, their insights. It's been exceptionally helpful. Kevin DeYoung, we're going to switch over to you so you can provide us your thoughts on Answer Connect, and we do see your screen.
Awesome, thank you so much. Yeah, this was a ton of information to go through. I will say, as we begin looking at CCA Answer Connect, you will have the opportunity for everybody on the webinar to have one of our excellent sales representatives follow up with you, if you so desire, to go into a bit more detail on some of the topics I'm going to show here as a follow-up to the content that was covered. What I think is important as we begin to look at CCH Answer Connect is we really wanted to focus, as we developed this tool a few years ago, to focus on the tax research workflow that a researcher would go through. How do we compile information that will bring everything that you need to see on a given topic to you without making the researcher go into various areas of a platform to pull that content, while making sure you're seeing everything. You don't have to have that issue of what didn't I see? That may actually have an impact on the research project that I am currently doing. And again, as I put this together, I wanted to really focus on, in this case, some of the US component and the foreign tax credits that were discussed. I am on my international topic page here. We do have a complete suite of information on the Latin American countries that cover a great deal of what was covered on the webinar here. So again, you'll have the opportunity to request a follow-up if you so desire to see some of the additional information. Again, as we built this, we wanted to ensure that we allowed our researchers to enter the platform in the two most popular ways that research is being done, using either a keyword search or a code section. In watching a lot of researchers, we realized while some do know those code sections back and forth, the keyword searching tends to be the dominant way of getting into the service. So in this case, I'm just going to start out by doing a search on foreign tax. You'll notice CCH Answer Connect is beginning to give me information, questions and answers, some high-level information regarding this specific area that may or may not be applicable, as well as a link into the topic pages that were created to cover this information as well. Now, again, for sake of this example, I'm going to go into the credible foreign taxes topic page. And we're just going to do a real quick walkthrough of some of the contents that's available here, keeping in mind that tax research workflow that I mentioned as we began this process. So we are now in the topic page, and if I scroll down slowly, we're going to give a great high-level overview of what the topic is about. But then as we continue to scroll down, I know that we had mentioned some of the tests that were involved, the realization test, where we are now going to give into that, give you some of the examples regarding it, that gross receipts piece that we had done. There's an attribution requirement test, the cost recovery. So all of that is covered in this specific topic page. Great information here. In order to kind of scroll through quickly, I'm going to use my navigation bar on the left, which will take me then down into some of my recommended topics. So if you need to expand what you're doing the research on, you have the ability to do that as well. Followed up by, again, in that research workflow, we've brought the key primary sources to you. 901 was mentioned several times here, so you have the ability to go into that topic page, that code section specifically, but the editorial team also want to make you aware of some additional code sections that may be relevant to the process you're going through. We've also then brought in smart charts. So you have the ability to get additional information. Those practice aids. How do I take my fact pattern, whether it's in a checklist, a table, worksheets, all of that has now been brought to you in this presentation on the topic page. And then, we also have some CPE courses. So if you want to get additional learning, you have the ability to do that. I'm going to scroll back up really quickly to my key primary source and go into code section 901. And again, what you'll notice as we go into this page is we've creatively named this our 360 view, because across the top, we are now bringing to you all content related to code section 901. You're no longer having to jump around to locate that information. So we begin with our code section, followed by the regulations as we move from left to right. The CCH explanations, any cases, administrative guidance are all here as well. We then will bring you through the forms, the pubs. We saw this on the topic page, but again, we've brought those productivity tools to you for this use directly within there. We also then have a federal state comparison. So if you do need to see what the state is doing regarding the specific issue that the business is taking place in within the US, you have that ability. And finally, we have a more tab, which will take you to additional content, any journals that we may have out there, any of the tax treaties that will cover this information. We also have links directly to that content. So again, that is the 360 view. I do want to show the way of getting back to that topic page. So if that researcher did enter via the code section 901 directly, they do have the ability to go back to those recommended topics very quickly to look at the additional examples and information that's put out there. I'm going to go back to my home screen really quickly here. And as we talked about the tax treaties, again, I want to just take a really quick look here at how CCH presents this content within CCH Answer Connect to assist the researcher when doing that treaty type research. And we're actually going to take a look at the treaty between Spain and Mexico for our example here. So as we look from the bottom up in the screen, we do have the current treaty both in the native language as well as translated into English. We also then have any protocol information that has been added or modified the initial treaty language. Now, as anyone who does research within a treaty, it can be very cumbersome depending on the number of protocols that are in place. So what CCH has done for the researcher is created a tool called Amended Treaty, where if you simply click on the amended treaty, including protocol 1, you'll notice as you scroll through that we have struck out the language that has been removed by the protocol, and then in bold added that language back in. So you're actually looking at a document here that is the treaty if it were actually amended in place legally. As we know, that doesn't take place. So again, just a great way of being able to get through that content and seeing how a treaty actually would read with the protocols put in place for you. So again, high-level overview of CCH Answer Connect. Again, we would love the opportunity to dive deeper into this with you. And Sharon, do you want to pull up that last polling question?
Okay. Thanks, Kevin, for the great demonstration of CCH Answer Connect, and a thank you to our panelists, Kevin, Alfonso, and Devin. for a great and informative discussion. This will be the final polling question. Would you like a more in-depth demonstration or further details on the resources and tools available in CCH Answer Connect? This question will remain up as we wrap up today's event. Today's virtual coffee talk will conclude once the polling question is completed. As a reminder, there will also be a few quick survey questions for you to complete following the webinar. For anyone who answered at least 3 of the required polling questions and stayed connected to the entire webcast, you can expect to receive an email within 5 to 7 business days with instructions on how to access your CPE certificate. Please note the instructions will be sent to the email you used to enroll for today's event. Thanks to all of you for attending our September virtual coffee talk, and we will leave that question up for another 30 seconds, and this concludes our webinar today. See you next time.